My name is Kyle Rodder, and to talk about the markets today, and maybe a few trades in there as well. Clifford Bennett from ACY Securities is at the desk. Cliff, great to see you. Wonderful to have your company, of course. It's volatile. It's a bad day for equities. What do you think's going on here?
I think it's a field day for people who use different financial instruments to hedge their investment portfolio. No, look, we have everything literally at our fingertips. We have to understand markets are very dynamic at this point. We have to understand that the equity market rally of the last 6 to 9 months is finished. Does that mean we plummet downward like we are today, every day? Probably not. But it does mean we're in a long period of consolidation. And when you look at the economic fundamental backdrop, I've been doing this, I think it's 39, almost 40 years in a few months. And I've never seen such a bad economic matrix as exists in the world at the moment. You have the world's two largest economies, United States and China. Both have manufacturing in recession. Both have property market crashes going on, commercial and property, and it may even be worse in the US than it is in China. Europe has a war. The whole Western economic structure has inflation. China doesn't, which is why they were able to cut rates yesterday by 15 points, 2.5. So the soft landing for China is there, but so far we can't see the airport. For the US, the soft landing was kind of happening, but we're not sure if we're going to stop before the end of the runway at the moment. Because look at yesterday's data. Sorry, I'm really going on, but I'm feeling quite passionate about this at the moment. Yep. Look at yesterday's data in the US. Retail sales, 0.7%, fabulous number. Nearly twice what was expected, right? A lot of it was Amazon sales, a lot of it was department store sales. That's the best the consumer can muster. It's still a great positive number. This one here is the Empire Manufacturing. I'm not sure if we're showing that at the moment.
There it is, yeah.
Empire Manufacturing Index, manufacturing in recession, another disastrous number from that particular index, but all of the data across the manufacturing sector is bad. And then last night we had, if it's going to come up, the NAHB housing index, which, look at that. See that spike to the low? That's COVID. So that's COVID lockdowns. That's the kind of level of activity the United States has at the moment in its housing industry. And not only that, it was starting to look like it could recover, but now it's tanking again. From 56 to 50 it dropped yesterday. The housing industry is going to stay in recession for some time. That's what that's telling me. Manufacturing is in recession. Retail sales, that's as good as it gets, to steal from the movie title. Jack Nicholson, highly recommended. But I think we have to say the world's two largest economies are in trouble. China's exports are tanking, which means global demand's dropping. Europe still is a highly problematic location heading into winter. How could you be bullish equities? Okay, and the market's been running up on share buybacks. Apple stopped doing share buybacks. Their stock fell 10% in a couple of weeks. If anyone is arguing that the US economy is strong, I can't see it. And the real problem with that head in the sands approach, and let's just be all optimistic and talk the market up, the problem with that is that on the Hill in Washington and at the Fed's not going to be cutting rates because inflation's actually started to tick back up. It's much better, but they're not going to be cutting rates. And in the administration, all they want to talk about is and they're still saying it. They're still saying it. The economy is strong and we're a beacon to the rest of the world. So what does that tell you? There are no rescue packages for the US economy coming. So there's not going to be the kind of policy response that previously we saw to recessionary risk in the United States, which makes it highly more probable that it's going to be happening. And therefore, when you have equity PE ratios above average, they should be way below average in this kind of economic environment. So if stocks start to slip to the downside, it'll mean that the excess liquidity and the share buybacks that were artificially distorting 7 stocks and driving the whole index higher, that period could come to an end. And if reality bites, it's going to bite pretty hard. So, when these things sort of separate, when you have equity market sentiment and fundamentals sort of going in opposite directions, one has to give way. Either the economy recovers and catches up to the equity market, which is what the Wall Street ivory towers want. But on Main Street, what the Main Street managers of big corporate America are telling us, there's more pain to come because they're laying off hard to get staff. They wouldn't be doing that if they thought there was a turnaround in sight within the next 18 months to 2 years. So Main Street doesn't see it. There's a disconnect between Main Street companies and Wall Street ivory towers. And I think the Wall Street ivory towers have it wrong. And the crash of the gap is going to be the market towards reality, unfortunately. And that's why I was talking about, use today's advanced instruments, financial instruments, to get on top of things.
So to distill that, no soft landing, stocks looking weaker. I mean, is it simply a matter of, depending on, again, which financial instruments you like to use? Obviously, popular products is obviously, what ACY, which you're a part of, potentially provides, but you just short this market at these levels. Is there anything that you feel more optimistic about potentially?
Shorts are a harsh word. Okay? I don't want to come across too much. I am a bit of a cowboy, but I don't want to come across that way. So what I would say to you, I'm not saying to people, you go out and you sell all of your stock portfolio. But as you know, the first week of January a couple of years ago at the market height, I did say that was the top for now. And we were going to have a 6 to 18 month, maybe a 3 to 6 year correction. We've just had a long rally. I think we're going to have another 1 to 2 years sideways, too heavy from here. If you want to keep your stocks, because there's dividends and you might want them for the long term, that sort of thing, and I could be wrong, and you never know what a market's going to do, to be honest, but you can use CFDs and indices to hedge your portfolio. And they're very liquid, they're very available instantaneously. So, whatever percentage of your overall stock holding portfolio you want to hedge, you can do that very easily using some of these instruments. So you can short those, but you're not really going short the market, you're just hedging some of your exposure. Yeah. And I think that's a nice defensive way to play.
Interesting. Okay, so there's that from, I suppose, a broader equity point of view. I mean, again, if you are a little bit more to, or adventurously inclined, I guess you could say, I mean, are there any trades there that you tend to interested in? Gold might be one that in a risk-off environment.
Yeah, black gold, oil. Very bullish oil. I've been bullish oil for a long time. Goldman Sachs caught up with us the other day, making a forecast, I think, of $94. I mean, I've been seeing it going to that level for some time. I think there's more in the oil market. It's got a bit of a consolidation. Oil and gold are being hit by a strong US dollar. And the strong part of the strong US dollar is the distortion towards the US too big to fail banks. Because if you're a US corporation with cash accounts overseas, why would you leave them at risk in banks overseas when you can bring them home, put them in the too big to fail basket and have the federal government insure your deposits? I mean, it's a bad policy. But not only does it distort the American banking system away from regional banking, it also attracts capital flows back for US companies, and it makes everyone in the world, literally everyone in the world, think about, why not open an account with one of those big six or whatever in New York, and my deposits are guaranteed, and I can go to the Amalfi Coast or whatever it is and not worry about any risk to my cash account. So I think there is some capital flow there. I think it was about 147.8 billion flowed into the US last month, and that looks like staying strong. And also remember, the bond yields are going up, so that's going to attract capital. So I think the US dollar could be firm. Why I'm talking about that is that weighs down oil and gold, but they're both showing signs of having their own resilience, perhaps oil more than gold. I'm seeing resilience in those markets that may not be there in some other commodity markets, but we've got to remember there's significant geopolitical pressures building, and there's no quick resolution to any of those geopolitical issues. And I think the China-US decoupling will continue apace, actually. But if I was going to be buying anything, I think US bond yields are going to go higher. I think commercial lending rates in general in the US are going to go higher. I do think the US dollar can remain surprisingly firm even if its own economy goes into recession. And I do think gold, oil look good, and equities are at best sideways for the next 6 to 18 months.